morning, I'm Maiki Oreta and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and the insights you need to navigate, adapt, and lead. Let's dive right in. Economic Planning Secretary Arsenio Balisacan is confident that the country will reach upper middle income status next year. U.S. President Donald Trump warns of reimposing tariffs on countries that fail to negotiate with Washington. Bilyonaryo Manny Pangilinan assures Meralco's customers that the company is working to lower electricity rates. First, let's take a look at how global financial markets performed overnight, with investors worldwide monitoring trade talks and tech earnings that could influence capital flows into emerging markets like the Philippines. U.S. stocks rallied for a third straight day, driven by strong gains in technology shares. Investors weighed a mix of corporate earnings results while also tracking signs of progress in the long-stalled U.S.-China trade standoff, a key global risk that could affect exports and investor sentiment across Asia. Beijing has renewed its call for the cancellation of American tariffs on Chinese goods. This followed comments by U.S. Treasury Secretary Scott Bessent, who signaled that the White House is open to de-escalating trade tensions, a move that, if realized, may improve outlooks for trade-dependent economies like ours.
Well, when we look at the market from a technical standpoint, certainly going into mid-April, everything was basically oversold. We had lots of technical indicators that reached extremes, things like the volatility index, the percentage of stocks above the 200-day moving average, the put-call ratio. So stocks were very, very oversold coming into April.
The Dow Jones Industrial Average rose 1.23%, the S&P 500 climbed 2%, and the tech-heavy Nasdaq jumped 2.74%, reflecting strong interest in growth stocks that often offset the tone for global market sentiment. Over in Europe, stocks also posted gains. The UK's FTSE 100 added less than 0.1%. Germany's DAX surged 0.5%, and France's CAC 40 gained 0.3% as investors there eye central bank guidance and global demand signals, both crucial for Philippine exporters. The National Economic and Development Authority says that the Philippines is on track to achieve upper middle income status by next year, despite mounting global risks and uncertainty in world trade. This milestone could mark a turning point for investor confidence, foreign direct investments, and the country's long-term economic trajectory. Sujin Kim has the details.
The Philippines is inching closer to a long-awaited economic milestone.
We anticipate graduating to upper middle-income country status by next year.
Chief Economic Planner Arsenio Balisacan is confident that the country will achieve upper middle-income status by 2026, despite rising global risks and deepening uncertainty in world trade.
Nobody expected that uncertainty would heighten this far. We're crossing our fingers. I think that there are risks out there, but we also have been quite watchful and vigilant. No? We are adjusting our policy tools to ensure that our economy maintains its resilience amid these uncertainties.
With the release of first quarter GDP figures just ahead, economic managers are looking to the numbers for clarity on how the country is weathering global headwinds. The government is still betting on a 6% growth target for 2025.
So now we are sticking to that. We hope that the numbers are not that bad. There were many times in the past when we outperform the growth prospects or target estimates of IMF or World Bank or ADB.
Next week, middle-income nations, including the Philippines, will gather to push for structural reforms and strategic cooperation in the face of global volatility.
Middle-income countries such as the Philippines are well positioned to take on a bigger role, both economically and politically, in the global stage.
The high-level conference of middle-income countries will take place from April 28 to 29 in Makati City. Sujin Kim, Bilyonaryo News Channel.
Infrastructure spending is expected to dip this April, a seasonal slowdown tied to the election ban. Budget Secretary Amena Pangandaman says that the temporary decline is due to the midterm election spending ban. However, she notes that disbursements historically pick up strongly in May and in June. She remains optimistic that infrastructure spending will stay robust for the rest of the year, driven by ongoing projects approved and started before the ban took effect. This is key as infrastructure continues to be a critical growth driver, especially heading into 2025. The Commission on Elections has prohibited public works spending starting March 28th, a ban that will run for 45 days in line with election rules. The latest data from the Department of Budget and Management, or DBM, shows infrastructure spending and other capital outlays fell by nearly 20% in December, sliding to 146.7 billion pesos from 183 billion in the same month in 2023. Retail loans in the Philippine banking system are set to make up 25% of total loans within the next 3 years, a sharp rise that could impact consumer credit dynamics and risk management strategies. Moody's Ratings reports this share will be much higher than the 18% recorded in December 2021. The increase comes despite greater asset risks for banks, given consumers' increasing debt and reliance on unsecured credit. Moody's says retail loans will outpace non-retail lending, driven by strong credit demand and government policies to expand financial inclusion. The report also notes that robust economic growth and easing interest rates will further stimulate borrowing, making retail loans more attractive for banks diversifying their portfolios. U.S. President Donald Trump warns that he could reimpose reciprocal tariffs on several countries within 2 to 3 weeks if they fail to engage in trade talks with Washington. This latest threat raises the risk of a re-escalation in the global trade war, a flashpoint that has already stoked fears of a slowdown in both the United States and in world economies. Trump had temporarily suspended the tariffs 2 weeks ago to give room for negotiations. But with no major breakthrough so far, he now plans to raise the issue directly with world leaders when he travels to Rome to attend the funeral of Pope Francis. Any fresh round of tariffs could affect global supply chains, including those linked to Philippine exports, manufacturing, and investment flows.
Do you have meetings with other world leaders when you're in Rome?
Yes, I will.
Which leaders do you want to meet, sir?
Well, I'd like to meet them all. That would be nice. I'd like to take care of all of them, but we have many of them there, and they all want to meet. They want to meet about trade. And we are making some great inroads and great deals.
U.S. President Donald Trump's new round of auto tariffs, including a 25% duty on imported cars, parts, and electric vehicle components, is rattling the global automotive industry. The Philippines may not be a major car exporter, but we're deeply embedded in the regional supply chain. From electronics and auto parts manufacturing to vehicle importation, that means local players and consumers could still feel the impact through higher costs and longer lead times. Joining us now is Vince Soco, chairman of GT Capital Auto and Mobility Holdings, to explain what this means for the industry, the car market, and what Filipino consumers should be watching out for. Hi, Vince.
Good morning, Mike.
Good to have you with us. Exciting times, and it's going to come with change. So for the auto industry, you're the best for that.
Oh, wow, thanks.
Okay, all right. So Vince, Trump's tariffs on the auto industry. What was your initial reaction to this? From the boardrooms to your conversations with people within the industry, what was your initial reaction?
Well, I think the tariff play or tariff increases were expected. That was part of his campaign for president when he ran last year and eventually won. So I think they were expected to be put on the table. But what was surprising was the extent of those tariffs and how it escalated so quickly. I think that was what was surprising. And right about now, there's so much confusion around them, up to what extent it will probably go and which countries would be most affected. All of that is being negotiated now, and we just have to keep monitoring the situation.
Yeah, it's 25% duty on all auto imports to the United States and auto parts that threatens to disrupt over $460 billion in global trade. How do you think this is going to shake up the global auto landscape, especially for emerging markets like the Philippines?
Well, the short answer is it's complicated. Tariffs never are easy because they're like dikes. You put them up and it directs the flow of water. In this case, the flow of trade. And if you think about it, it's one thing to be able to impose tariffs on completely built-up vehicles. You can count them as single units and impose a tariff on each one of them. But when you look deeper, each internal combustion engine car is comprised of about 30,000 component parts. Even EVs are about 15,000 component parts. And each of those are a line item which is subject to specific tariffs. And that makes it even more complicated. So really being able to determine the impact is an effort in itself and will take time.
Yeah. Well, the only thing with tariffs is that prices go up.
That's the only certainty there is.
That's the only certainty we have. Speaking of the U.S. market, the U.S. imports about half of everything that they sell. So they really love their foreign brands. I mean, Americans have come to love the Range Rovers, the Lexuses, the Toyotas, What now? What do you think is going to happen? I mean, you don't see them replacing the Range Rover for a Cadillac. I mean, how do you think this is going to shift demand in America, and how do you think that's going to trickle over here in Asia, particularly for us?
Well, the U.S. car market has always been the epicenter. Every car maker was looking at it. It was and continues to be a big market for cars, and until China became ultimately the largest car market. And Americans love their cars. And more importantly, Americans love choice. Yeah. And this is what has been the premise of growth for the industry. Every car maker, every car brand has been there, and they've made choices.
Yeah.
And now
to limit their choices to GM, Ford, and Chrysler. I don't know how that's going to be.
Well, yeah, I'm not really sure how it's all going to play out, because then this whole tariffs, as I said, are still being negotiated. So how the European brands will be affected, how the Asian brands will be affected, how the Chinese brands will be affected.
Or the solution would be for them to set up factories and distributorships, factories in America, but that's long.
Yeah, and that's the hope. One is that, of course, that the car makers will onshore. I think most of the major car makers already have factories in the U.S. to a certain extent, but they would like to see more of that to be onshore.
That's hard because the
but
skill
that
sets
takes time. So building capacity will take time, and it really does take, more importantly, a long-term policy view. This is tariffs push right now. Whether this will be continued by the next administration or the administration after that, we're not certain. And for automobiles, the gestation period of investments goes very well from 8 to 10 years before you can even realize the returns on those investments. So long-term stability in policy is critical.
Here in the Philippines, we don't export finished cars at scale, but we are deeply embedded in the value chain, in the regional value chain. How do you think our industry is going to be most affected by this?
Well, we do have in the Philippines component part makers that supply parts to the United States and other parts of the world. But to the United States, we have meter assemblies, sensors, some electronic components, wiring harnesses. And so certainly there's a potential for them to be impacted, because if demand drops, then obviously the amount of exports will also drop. However, what's equally important is there might be an opportunity for us to increase in the event that production does increase in the U.S. I mean, the announced or indicative tariff to be imposed on the Philippines is 17%, which is much lower than our ASEAN neighbors. So there is an advantage for us and an opportunity if we can really position ourselves for this eventuality.
Yeah, interesting. So, the risks, we can't do anything about that. We don't even have a seat at the table when it comes to the tariff discussions.
Absolutely.
So they're there. What we need to focus on are the opportunities at hand. What are the opportunities at hand for the Philippine auto industry, Vince?
Yeah, so I think the impact of the auto tariffs is just so, the importance is just so clear. I mean, it's rattled cages, it's brought leaders together to the table because the impact to auto industry is really huge. And it underscores the importance of the industry to economies worldwide. And so we are not a major player, but we can be a part of the global supply chain. The supply chain for automobiles really expanded in the early 2000s, and it has really created a new ecosystem. And unfortunately, because at the time, the Philippine industry was not at its prime, so to speak, we were not able to participate in that. But right about now, with the Philippine auto industry growing at the rate it's growing, I think there's a great opportunity for us. We're starting to build economies of scale. The production quality is here. We have the labor, that's important. And so we have a chance to really break in with this potential realignment that's going to happen.
Right. Speaking of growth, auto industry grew by 9% in 2024.
Yes.
For 2025, despite the tariff uncertainties, you're projecting about a 9% growth, which is still pretty good, given all things considered.
Yes, absolutely. I mean, this year it's going to be, last year the 9% growth resulted to a new record high for the industry at 475,000 units. And this year, a new record is expected to be set again with sales breaking through 500,000, the 500 million mark. And that's really showing how strong and resilient the market is. The Philippines is still continuing its journey to motorization. And with economic growth, I think there's such a runway ahead of it.
Yeah, we've got 6 to 8% target for the government.
Yes.
We're looking at about 6% growth. On top of that, inflation is at bay, 1.8% in March. That's a 5-year low. And interest rate cuts, we're expected to have more in the second half of 2025. How important is a looser stance on monetary policy for the auto industry, given everything that's going on?
Yeah, I think that's a great driver. We've always said that the automotive industry will continue to grow only if credit is made more accessible. It's a driver of growth, to be sure. And lower interest rates will also be the wind under the wings, so to speak. So the lower inflation rate, which actually started to impact on domestic consumption in recent months, bring it down to lower than 5%, which is its usual growth rate. It's back to 5%, so that's also very encouraging. So all of these are very positive developments for us in the auto industry.
Yeah,
we're watching it very positively.
So the auto industry in the Philippines has a very long runway for growth, 2025 and beyond, despite
everything that's happening right now. Of course, we have to be worried about and I think this is the real story behind the tariffs. It's the impact on the global economy. Already the IMF has already reduced by 0.5 point its estimates for economic growth for the global economy as a result of the tariffs. And that's what we have to be worried about, because it will impact a broader spectrum of the business sector and industry, and potentially might reduce economic growth. And that's where we have to be careful.
Okay. All right. Thank you so much, Vince Socco, for your time. It's always nice learning about the auto industry from you. We'll have to have you back because we didn't even get to touch on EVs.
Absolutely.
So much to talk about.
Thank you so much for having me.
So little time. Until next time.
Thank you. Thanks, Maiki.
All right. We're going to take a quick break. Please stay with us as we dive deep into the numbers and the narratives that matter most to your bottom line. Welcome back. Let's check on how Asian markets are moving this morning following the gains in Wall Street overnight. The Nikkei 225 is up by 1.42%, up sharply in early trade. Hong Kong's Hang Seng Index is in the green by 0.8%. Shanghai's composite is absolutely flat, neither up nor down at 0.00. Singapore's Straits Times Index, however, is going the other direction. It's down right now by just a bit, just by 0.3%. Here at home, Philippine shares extended their winning streak for a third straight session yesterday, Thursday, tracking the gains on Wall Street. The main gauge rose by 0.4% to close at 61.68 as investors brushed off trade tensions and took cues from a global rebound. Over the short term, market momentum, however, remains cautiously optimistic, with investors eyeing fresh signals on U.S.-China trade developments and broader global risk sentiment. Taking a look at the PSE index as of 10:23 this morning, main gauge is well entrenched in the green, up by 1.13% to 62.28. All shares index in the green as well, up by 0.7% to 36.85. Now, all the sub-indexes are showing some strength. All are in the green. The financials counter is up by 1.5%, and the services counter is up by 1%, as with the property counter. Volume is at 725 million, while value is just under $1 billion. Now, global banking giant JP Chase and Company becomes more bullish on Philippine equities, recommending increased investor allocation to local stocks over other regional markets. The bank upgrades its rating on Philippine equities to overweight, calling the country a winner from its previous neutral rating. This comes despite global turmoil caused by U.S. President Donald Trump's tariff threats, which have rattled investor sentiment. JP says that the Philippines remains the most domestically driven economy in Southeast Asia, offering greater resilience against global export volatility. Nevertheless, JP slashes its 2025 target for the Philippine Stock Exchange Index to 6,700, around 8% upside from current levels. On another front, the Department of Energy, or DOE, is calling on Meralco to lower its electricity rates. This after Congress renewed the power distributors franchise for another 25 years until 2053. At the 2025 Giga Summit of the Meralco Power Academy, or MPA, Energy Secretary Rafael Lotilla stressed that a distribution utility's performance should be evaluated based on its ability to provide affordable power to Filipino consumers, particularly in the current economic climate, where cost of living increases are putting pressure on households and businesses. Lotilla acknowledged that Meralco's rates are still higher than those of other electric cooperatives and distribution utilities in the country. This raises questions about competitiveness in the sector, especially as many businesses rely on affordable power to drive operations and stay compliant with global sustainability standards. However, he commended Meralco's use of technology in disaster response and stability, a crucial aspect for ensuring reliable power delivery, particularly in a country that faces regular natural calamities. He urges other operators to adopt similar technological solutions, which could improve the industry as a whole and help lower costs over time. Bilyonaryo Manny Pangilinan says Meralco is working to lower power rates in response to pressure from the public and the government to make electricity more affordable. This follows Energy Secretary Rafael Lotilla's call for Meralco to lower prices after Congress renewed the power distributor's 25-year franchise. At Meralco's Giga Summit 2025, Pangilinan, the company's chairman and CEO, says they hope to reduce costs at the distribution level. Pangilinan explains that Meralco continues to face criticism over rates, even though it doesn't generate electricity or profit from it. Despite this, he says lowering rates is in the company's best interest, especially as energy costs affect both households and businesses. And that's it for Business 360. I'm Maiki Oreta. Thank you for joining us, and keep it here on BMC, the Bilyonaryo News Channel.